There's a moment in every crisis when things stop being isolated incidents and start becoming a pattern. We're in that moment now. Across America's corporate landscape, something unprecedented is happening. Not since the immediate aftermath of 2008, not since the financial system itself was on the brink of total failure, have we witnessed what we're seeing today. Companies that weathered the worst economic catastrophe in modern history are now filing for reorganization and liquidation at a pace that's genuinely alarming. Through the first 10 months of 2025, we've already surpassed 655 major corporate insolvency filings. That's not just a number. That's double what we saw in 2022. That's nearly equivalent to an entire year's worth from 2024. And the velocity shows no signs of slowing down. The industrial sector has been hit particularly hard. Nearly 100 significant manufacturing and industrial enterprises have already gone under. But the damage isn't confined to factories and warehouses. The retail world is equally troubled. Companies that supply goods to American households are struggling. Businesses built around consumer spending are contracting. And what makes this especially striking is that these aren't marginal players or overextended startups. These are established enterprises. These are companies with long histories, deep supply chains, and thousands of employees. Consider what happened to First Brands Group. For decades, this organization sat at the very top of the American automotive supply chain. It produced components that went into vehicles across the country. The company had survived recessions, competitive wars, market shifts, the entire brutal arc of modern American manufacturing. Yet in 2025, First Brands Group collapsed into bankruptcy court, with liabilities totaling approximately $50 billion. Investigators discovered something even more disturbing. Roughly $2 billion in funds that simply disappeared or cannot be accounted for through standard business practices. The company's bankruptcy filing revealed a business that had been pushed past its operational limits. Auditors discovered that the same invoices and collateral had been pledged multiple times to different creditors, a desperate financial maneuver that signaled a company fighting for survival, cutting corners, and abandoning standard practices. The culprit? First Brands Group was explicit about it in official court documents. Tariff policies enacted during 2025 created a sudden, massive surge in the cost of raw materials and component imports. When you're running a company with massive fixed costs and long-term debt obligations, and suddenly your input costs skyrocket overnight, the math becomes brutal very quickly. The company couldn't pass those costs downstream to automakers who had locked in their own supply contracts. It couldn't liquidate assets fast enough. It couldn't borrow more money because its balance sheet was already stretched. So it tried increasingly complex financial maneuvers. It pledged assets to multiple lenders. It borrowed short-term money to cover long-term obligations. And eventually, inevitably, it ran out of runway. But First Brands Group was just the beginning of what would unfold in the subprime lending space. Primal Lend, a major player in the high-risk auto loan business, followed a similar trajectory into Chapter 11 reorganization. This company had operated under different circumstances than First Brands. Rather than manufacturing physical goods, Primal Lend existed within a particular economic moment, one where access to credit had been encouraged, where lending standards had been loosened, and where rapid growth was rewarded by markets and policymakers alike. What changed? Everything. By 2025, inflation remained stubborn. Interest rates stayed elevated. Used car prices, which had been artificially elevated by supply chain disruptions, began normalizing downward. For borrowers already operating on thin margins, people taking on subprime auto loans are usually people with limited financial flexibility. The equation suddenly shifted. Their monthly payments stayed the same, but their vehicle's resale value dropped. If they needed to refinance or sell, they were suddenly underwater. Defaults accelerated. Collections became harder. And Primal Lend, which had been built on the assumption of continued credit accessibility, imploded. Then came Trrical Holdings, another major subprime lender that entered full liquidation in September 2025. But this case was different. Investigators uncovered evidence of something darker, systematic fraud. The same collateral, the same vehicles, the same title documents had allegedly been used to secure multiple different loans. This wasn't an accounting error or a valuation misstep. This was conscious deception, a company creating the appearance of assets to justify additional borrowing. And when auditors pulled the thread, the entire structure unraveled. What these three cases reveal isn't simply bad management or unlucky timing. They demonstrate a system under stress, a system where companies that survived historical recessions are unable to survive the current pressure. A system where standards have eroded to the point where fraud becomes a survival tactic. A system where the normal rules of corporate operations have fractured under strain. Part 2. The policy dimension. This is important. These bankruptcies aren't random. They follow directly from specific policy decisions made in early 2025. The Trump administration implemented a comprehensive tariff strategy aimed at reshaping American trade relationships. Import duties on industrial goods rose sharply. Components, raw materials, machinery, and assembled products all saw significant tariff increases. The stated goal was to revitalize American manufacturing by making imports more expensive than domestic production. The practical outcome was instantaneous and brutal. American companies dependent on global supply chains suddenly faced a massive increase in their operational costs. For manufacturing businesses operating on typical profit margins of 5 to 10%, that kind of shock is catastrophic. A 20% increase in material costs doesn't reduce profits by 20%. It can wipe out all profit entirely. Companies holding long-term debt taken on under previous economic assumptions suddenly found those debts unsustainable. Companies with fixed contracts couldn't raise their prices. Companies with global operations faced currency complications, retaliatory tariffs from trading partners, and shifting demand patterns. The industrial sector, already operating under pressure from years of labor costs and competition from lower-wage countries, simply couldn't absorb this shock. 100 large industrial firms filed for bankruptcy in this environment. That's not a coincidence. That's a direct policy outcome. Simultaneously, the administration encouraged expanded financial inclusion, loosened lending standards, and created an environment where subprime lenders felt comfortable expanding rapidly and taking on riskier borrowers. The logic was straightforward. More people access credit. More people participate in the economy. Economic activity expands. The theory had appeal. The execution had consequences. When lending standards loosen and credit becomes readily available, riskier borrowers do enter the market, but they do so at higher rates of default. When growth is incentivized without corresponding oversight, fraud emerges. When regulators are discouraged from strict enforcement, the system finds ways to stretch the rules until they break. Primal Lend and Trrical Holdings represent the outcome of that environment: rapid growth, loose standards, and eventual collapse when the underlying economics proved unsustainable. Part 3. The capital drain. But tariffs alone don't explain the full scope of what's happening. Something else has fundamentally altered the capital markets in 2025. The United States is now in what analysts describe as an artificial intelligence spending race, and the capital flowing into that race is extraordinary in scale. Initial estimates suggest that building out the necessary AI infrastructure, the data centers, the processing power, the energy systems, the security networks, could ultimately require $5 trillion in investment. $5 trillion. To put that in perspective, that's approximately 20% of annual American GDP. That's a sum larger than the GDP of every country on Earth except the very largest. That money has to come from somewhere, and in modern capital markets, it comes from borrowing. Major financial institutions began analyzing where those funds would originate. J.P. Morgan's research teams examined the bond market specifically. Their conclusion: approximately $1.8 trillion in new debt securities tied to AI infrastructure and development would be issued in 2026 alone. That's just the beginning. Hyperscale technology companies, the firms building the massive data centers and securing the computing power, would need hundreds of billions more in subsequent years. Here's what happens when that much capital concentration occurs in a single sector. It distorts everything else. Capital markets are not infinite. There's a relatively fixed amount of capital available at any given time. When massive AI and technology companies issue wave after wave of high-grade debt securities, investors naturally prioritize them. Why? Because these are financially strong firms with predictable revenue streams. They're issuing investment-grade bonds with attractive yields. For a pension fund manager or insurance company investing other people's money, these seem like sensible bets. The companies are backed by enormous market valuations. The business models seem durable. The risk profile appears manageable. But there's an opportunity cost. Every dollar flowing into AI infrastructure bonds is a dollar not available for a regional manufacturing company, a mid-sized retailer, a transportation equipment producer, or any traditional American firm trying to grow, upgrade its facilities, or weather economic pressure. So, what happens? Those other companies face two increasingly grim options. They either pay significantly higher interest rates to borrow money, which itself can push marginal businesses into insolvency, or they discover that capital simply isn't available to them at any price. Lenders are fully committed to the AI boom. Traditional business lending has become a lower priority. This creates a vicious cycle. Non-technology companies facing higher borrowing costs cut back on expansion equipment purchases and hiring. They generate less revenue. They miss earnings targets. Their credit ratings decline. Banks grow more hesitant to lend to them. Their financial stress increases. They miss debt payments. They file for bankruptcy. Meanwhile, the AI giants continue to raise capital, continue to invest, continue to expand. The gap widens. The concentration increases. Research firms that track corporate borrowing costs found that by mid-2025, non-technology firms were paying yields significantly higher than they had paid just 2 years earlier. For weaker companies, those already carrying heavy debt loads or operating in cyclical industries, that spread became prohibitive. These aren't firms that are failing because they're poorly managed or their products are obsolete. They're failing because the financial system has been reshuffled in ways that make it nearly impossible for them to survive. Add that to the tariff-driven cost increases, and, well, the answer becomes clear. Companies are crushed from both directions. Costs are rising because of trade policy. Capital is scarce and expensive because it's flowing toward AI infrastructure. For firms trying to navigate both realities simultaneously, bankruptcy isn't a failure of management. It's a structural inevitability. While the private sector is fracturing under these pressures, the federal government faces its own version of the same challenge. The United States Treasury has enormous borrowing needs in 2025 and beyond. Interest on existing debt is substantial. Refinancing needs are enormous. Existing Treasury bonds are maturing at a rapid pace and must be rolled over or replaced with new debt. Simultaneously, the government still needs to fund ongoing operations, even if spending growth has been constrained. All of this borrowing must be absorbed by bond markets that are simultaneously absorbing massive amounts of corporate borrowing, including that enormous wave of AI infrastructure debt. The Treasury can't mandate where money flows. Markets are ultimately free to allocate capital according to their assessments of risk and return. So, the government faces a version of the same competition problem that private companies face. How do you borrow money in a market where capital is being pulled towards specific, higher-returning assets? Treasury officials made a strategic choice: shift more borrowing into very short-term debt. Instead of issuing long-term Treasury bonds, 30-year securities that lock in today's rates for 3 decades, the Treasury issued increasing amounts of Treasury bills that mature in months or even weeks. The advantage is obvious. Short-term yields are lower than long-term yields. A Treasury bill might carry a 4.5% yield, while a long-term Treasury note might carry a 5.5% yield. By favoring short-term debt, the government saves money today. The disadvantage is equally obvious. Short-term debt must be constantly refinanced. When that Treasury bill matures in 3 months, the government must borrow again. If interest rates have risen, the cost of renewal is higher. If market conditions have deteriorated, renewal might be difficult. The government is essentially making a bet that interest rates will either stay the same or fall, allowing cheaper refinancing of that short-term debt. If rates rise instead, the cost of managing that debt rises sharply and immediately. Meanwhile, the long-term Treasury yield, that 10-year rate that anchors mortgage rates, corporate lending rates, and countless other financial instruments across the American economy, has remained stubbornly elevated. 10-year Treasury yields have stayed above 4% throughout 2025, with periods of higher volatility. That elevation signals that investors remain skeptical about future inflation trajectories and about the government's fiscal path. It signals they're uncertain about future demand for Treasury bonds. It signals they're pricing in risk. So here's the dynamic. The Treasury is saving money today by borrowing short-term. But it's doing so in an environment where long-term interest rates remain elevated, where long-term financial stress is being priced into bond markets, and where the government will eventually need to refinance that short-term debt or convert it into longer-term obligations at potentially much higher rates. It's a short-term fix masking a longer-term problem, and it depends entirely on the assumption that capital will remain available for refinancing. What happens if that assumption proves wrong? What happens if, in 6 months or a year, the Treasury tries to refinance $300 billion in maturing short-term bills and finds that investors have lost faith? What happens if the AI boom falters and investors suddenly have less confidence in the companies issuing those $1.8 trillion in new bonds? What happens if foreign central banks, institutions like China's Monetary Authority, decide that holding Treasury bonds no longer makes sense? The government would face higher refinancing costs precisely when it needs to refinance most. It would be forced to issue long-term debt at elevated rates, locking in higher costs for decades. We're not at that point yet. But the structure is increasingly fragile, and the government's reliance on short-term solutions is visible to every analyst watching these markets. Part 5. The Employment Crisis. The human cost of all this financial restructuring is becoming visible in employment data. Official statistics from the Bureau of Labor Statistics show that American manufacturing has shed tens of thousands of positions since April 2025. Detailed analyses, triangulating across multiple employment metrics and survey instruments, estimate that approximately 42,000 manufacturing jobs have been lost following the tariff actions of early 2025. That's a significant reduction in a single year. The BLS Employment Series also documents declines in specific subsectors: transportation equipment manufacturing, semiconductor production, and industrial machinery. These aren't statistical artifacts or data measurement quirks. They're real people. Workers who had jobs in April are no longer employed in those positions. The facilities where they worked are operating at lower capacity or have shut down entirely. This is significant because manufacturing employment is geographically concentrated. It's not evenly distributed across the country. Specific regions have built their entire economic identities around automotive production, machine tool manufacturing, or semiconductor fabrication. When those industries contract, entire communities feel the impact simultaneously. A factory closure or significant workforce reduction in a mid-sized American city isn't like a layoff in a major metropolitan area where people can find other employment relatively quickly. In smaller manufacturing-dependent communities, when the anchor employer shrinks, everything else starts failing. Retail struggles because workers have less spending power. Local tax revenues decline because commercial activity drops. Suppliers lose customers. Commercial real estate becomes underutilized. But the employment impact extends beyond direct job losses in manufacturing itself. When companies face the dual pressure of higher material costs and limited access to capital, they don't just fire existing workers. They cancel expansion plans, delay equipment purchases, and postpone facility upgrades. A company that might have hired 50 new workers in 2025 to expand production now freezes all hiring. A company that might have invested $10 million in equipment automation now defers that decision indefinitely. Those canceled decisions accumulate across hundreds of companies, and they represent thousands of jobs that never materialize. Simultaneously, the capital flowing into AI is creating a stark bifurcation in the labor market. High-skilled tech workers, researchers, and engineers are seeing significant opportunity and compensation, but they're concentrated in specific cities and specific companies. Everyone else, workers in manufacturing, supply chains, retail, and traditional services, is facing stagnating wages, reduced opportunity, and declining job availability. What emerges is a labor market that's increasingly unequal, increasingly regional in its disparities, and increasingly locked into technological sectors that can generate returns sufficient to justify their capital costs. Part 6. The Warning from Inside. Janet Yellen, former Treasury Secretary under the Obama administration and chair of the Federal Reserve until 2018, is not typically an alarmist. She's a careful economist who speaks measured language even when circumstances are concerning. In 2025, she broke from that pattern. Publicly and directly, she criticized the trajectory being set by recent policy decisions. Her statement wasn't about short-term market movements or quarterly GDP figures. It focused on something deeper and longer-lasting, the systematic weakening of America's research and innovation infrastructure. Yellen pointed out that tariff policies, unpredictable trade actions, and the proposed reduction of federal research funding are creating conditions where top-tier scientific talent would rationally choose to work elsewhere. Why would a brilliant scientist remain at an American university facing budget cuts and policy uncertainty when research institutions in other countries offer stable funding, clear long-term support, and growing resources? This isn't hypothetical. Early signs are already visible in academic recruitment networks and in reports from university administrators. Countries like Canada, Germany, and Singapore are actively recruiting American researchers, offering competitive compensation packages and multi-year research grants. Some researchers are accepting those offers. The consequence takes decades to become obvious, but it's predictable and measurable. Innovation slows domestically. Breakthroughs happen elsewhere. Technology companies that require access to cutting-edge research and PhD-level talent face constraints on hiring. Some operations migrate to locations where that talent is more available. Eventually, the ecosystem advantage that America built over decades, its concentration of world-class research institutions, its tradition of attracting global talent, its position as the world's innovation center, begins to erode. You don't feel this erosion in a single year. But after 5 years, after 10 years, when you look back and recognize that major breakthroughs in artificial intelligence, biotechnology, materials science, or renewable energy increasingly originate in other countries, that's when you realize what was lost. Yellen's warning is ultimately about this long-term risk, not about next quarter's earnings, not about this year's employment numbers, about whether America maintains the structural advantages that have made it competitive for half a century. Part 7. The Silent Strategic Shift. While American policymakers debate trade policy and corporate executives navigate bankruptcy proceedings, something extraordinary is happening in Beijing. Chinese authorities are purchasing gold at levels that are either unprecedented or deliberately hidden. The exact scale isn't entirely clear, which itself is meaningful. Official reports from Chinese government sources claim modest gold purchases. But trade data analyzed by major international financial institutions tells a different story. Shipments of gold from established trading hubs in London and Switzerland to Chinese custody are substantial and growing. Analysts at major investment banks, tracking these physical flows, estimate that China may be accumulating 250 tons or more of gold annually in 2025. Some estimates are far higher, suggesting purchases up to 10 times official government claims. Why does this matter? Because central bank reserve composition is a window into strategic thinking. Historically, central banks maintained their reserves primarily in currency, specifically in US dollars, Treasury bonds, and other dollar-denominated assets. This made sense. The US dollar was the world's reserve currency. American government debt was safe. Dollar-denominated assets were liquid and universally accepted. A central bank could move money efficiently using dollars, could settle international transactions in dollars, and could be confident the value would be relatively stable. But from the Chinese perspective, several factors are shifting that calculus. The U.S. is increasingly willing to use financial sanctions as a geopolitical tool. The U.S. government has threatened tariffs and restrictions on trade with China. The U.S. political environment is visibly unpredictable, and the dollar itself carries risks. If U.S. fiscal policy continues deteriorating, if deficits keep expanding, if the government is increasingly unable to manage its debt load, then dollar devaluation becomes a real possibility.